So in today's video, we're going to be talking about something really important, which is how to buy property. Now, I've had this question so many times, so I thought that we should definitely get into it, right? Just give me a second. Okay, I think you can see it now. So if you are buying property in South Africa, then you should be asking yourself the question of whether you put this property into your personal name or into a company name or a trust. And this decision is definitely not something that you want to make casually because it affects so much. It's not just an administrative decision. It is definitely not just a tax decision. And it's really not something that you should decide based on what sounds more professional, right? Because this choice can affect your rental income tax, your capital gains tax, your risk exposure, your estate planning, your financing options, and your long-term wealth and building strategy. And many people get this wrong at the beginning, and then they only realize later on that fixing the structure is so expensive, complicated, and sometimes it's really not practical at all. So in this video, I want to walk you through this properly. We're going to be talking about what happens if you buy property in your personal name, what happens if you buy property in a company name, the pros and cons of each, and how tax, capital gains tax, liability, and estate duty come into play. And most importantly, how to think about this strategically depending on your goals. Hi, everybody. I'm Humaira from HM Accounting, and on this channel, we break down real financial and business decisions in a very practical way. So without further ado, let's get into it. Now, why this decision matters more than people think, right? The why is so important. So before I even compare the two structures, I do want to start here because a lot of people think that this question is very simple. Which option pays less tax, right? That's what people think about. But actually, that is too narrow because the right structure depends on what you are trying to do with that property. So are you buying one property as a long-term investment? So for example, as your primary residence, are you buying a rental portfolio? Are you planning to flip the house or develop it? Are you bringing in a business partner? Are you thinking about family wealth and estate planning? Or are you trying to separate personal risk from business activities? Now, these are all very different situations. So when I explain this, I want you to stop thinking only in terms of which is better and instead start thinking about which is better for your specific strategy. Because structure is strategy. And if your structure does not match your strategy, you could end up paying more tax than necessary, taking on more risk than necessary, or limiting your future flexibility. Now, buying property in your personal name, right? So let's start with the first option, which is buying property in your personal name. Now, for many people, especially for first-time investors or individuals buying for long-term wealth creation, this is often the more straightforward route because one, your personal name can be more tax efficient for long-term investment. So one of the biggest reasons that personal ownership is often attractive is because of capital gains tax. Now, when individuals sell an investment property, there are certain advantages compared to properties. Individuals will benefit from an annual exclusion of 50,000 Rand as of 2026, as well as a lower capital gains tax inclusion rate, which is 40% as opposed to companies, which is 80%. Now, this really matters because if your long-term plan is to buy and hold and eventually sell at a profit, then capital gains tax becomes a very important part of the discussion. And this is where people often make a mistake. They focus too much on the fact that a company may look more formal or may look more structured, but they do not think ahead to the day that they sell that property. And that is where the tax pain can really show up. So from a long-term capital growth perspective, personal ownership is often more favorable. Now, the second thing is that you may benefit from primary residence exclusion. So if the property is going to be your home, right, then this becomes even more important. If you live in that property, then there may be a primary residence exclusion of 3 million rand as of 2026, which can make a major difference when the property is eventually sold. So this means that personal ownership can be especially beneficial when the property is not purely an investment, but also your place of residence. So already, if you are thinking about a home purchase or then personal ownership becomes very attractive in many cases. The third thing is that financing is often easier in your personal name. So it's another major practical point because banks generally prefer lending to individuals. Now that means financing can often be simpler, faster, and sometimes even cheaper. So even outside of tax, personal ownership may simply be easier to execute. And this matters because in real life, structure is not just theory. You also need to ask yourself, will you qualify? Will the bank finance this? How much of a deposit will you need? What kind of interest rates are you likely to get? What paperwork and compliance burdens comes with this? And in many everyday cases, the personal route wins on simplicity. The fourth thing is that there is lower admin and compliance. Now, when property is owned in your personal name, then the admin is generally far less burdensome than owning it through a company. You don't have the same corporate compliance requirements. You do not have annual company maintenance issues. You do not have the same accounting burdens or statutory obligations. So this does mean lower costs and less complexity. You do, however, still have to declare that income and expenses via your individual tax returns yearly, which SARS has increasingly begun to scrutinize. So this is the tricky part, and where a company is preferable is that SARS really scrutinizes your individual tax returns now, especially when you are claiming for rental properties on your personal names. So for many individual investors, that matters a lot. If you are only buying one property or you are still early in your investment decision, you may need the extra admin of you may not need the extra admin of a company structure, right? Okay, but now let's move on to the downsides of personal ownership. So the disadvantages, because obviously personal ownership is not perfect, neither is company. They both have their pros and they both have their cons. So the first thing is unlimited personal liability, and this is one of the biggest concerns, is that if the property is in your personal name, then you are personally exposed. So if something goes wrong, whether it is a legal dispute or a tenant issue or a contractual issue or another type of claim, your personal assets could potentially be at risk. So that is a very serious issue. Now, of course, the exact risk depends on the type of property activity and how exposed you are. But generally speaking, personal ownership does not create the same separation between your personal life and your investment activity. So if liability protection is a major concern, then this is where personal ownership may definitely feel less attractive. The second thing is estate duty implications, and this is also another major point. If the property is in your personal name, then the full value of that property forms part of your estate. And what exactly does that mean? Well, that means that it can increase estate duty exposure, and it can also create liquidity pressure when your estate has to be wound up. And this is something that many people do not think through or think about early enough. They think about the purchase, they think about the bond, they think about the rental income, but they do not think about what happens later on, especially from succession and a family planning perspective. So while personal ownership can be attractive for tax and for simplicity, it may be less ideal when estate planning is a big part of your strategy. And this is something key to note, because if you would like your beneficiaries or your family to continue on with the property after your death without interruption, then in the terms of holding it in your personal capacity, that becomes a bit of an issue, especially with the estate winding up process and the estate duty taxes. The third thing is that there's less flexibility for partners and for growing. So if you want to bring in investors or business partners or create a broader portfolio structure, then personal ownership can become a problem. It can become a bit awkward because there is no shareholding structure. So you cannot easily transfer shares. You cannot structure ownership as flexibly as you could in a company. So while it may work well for a single investor or a small, straightforward situation, it may not be ideal for more scalable property strategies. Now let's move on to the second option, which is buying a property in a company, right? Or buying a property through a company, such as a Pty Ltd. And this is where many people just assume that they are making the smarter move. So sometimes they think it looks more professional. Sometimes they think it must be better for tax. Sometimes they think it feels more like a business or that it will protect me. And some of those thoughts are totally valid, but not all of them automatically mean that it is a better option, right? Let's now look at the benefits of actually putting the property into a company. One is definitely the limited liability protection. So this is one of the biggest benefits of owning property in a company. It's the separation between your personal and your business assets. So this can offer a level of liability protection, meaning that your personal assets are generally more protected than they would be under personal ownership. And that's quite a big advantage. And it can be especially relevant when the property activity has greater risk. So for example, if you have multiple tenants or larger developments or commercial exposure or joint ventures or more operational complexity. So if risk protection is high on your priority risk, then company ownership can make a lot of sense. The second thing is that it's easier to scale and to bring in partners. So again, this is another major advantage because if your goal is not just to own just one property, but to build a portfolio of companies, then of properties within the company, then a company can offer more structure and more flexibility because you can issue shares, you can bring in partners, you can structure ownership more cleanly. And that is important when property becomes more than a passive investment. So once you move into the space of building, of growing, or of collaborating with others, a company becomes much more practical. The third thing is, again, the separation of your personal and business assets, similar to what we spoke of as point one, right? But a company creates a cleaner separation between your personal finances and your investment activities, which will definitely help with things like record keeping, financial reporting, strategic planning, and overall professionalism. So if you're treating property like a business, then the company often aligns better with that mindset. And SARS sees it as such as well. So that is why they're not as hard on companies as they are with you declaring it in your individual name. It is because with a company, there is a clear separation as to what belongs in the company and what is your personal expenses, which you will not be claiming. So SARS has more trust in the company structure, and therefore tax submissions are not as complicated, even though there is more admin work to do. And the fourth thing is tax planning flexibility. So a company may also create a certain tax planning, opportunities. So for example, company profit is currently taxed at the corporate tax rate of 27%, right? That is fixed. And profits can potentially be retained in the company rather than immediately extracting it, right? And this can be useful in some cases, especially where profits are going to be reinvested rather than distributed. There may be planning opportunities around timing and around cash flow. But this is exactly where people need to be careful because this benefit is often oversimplified. So people hear company tax rate and assume that the company is automatically more tax efficient. But that is not always true once you look at the full picture. And we will get into that in a bit. Now, the downside of company ownership is that higher overall tax in many cases. So there could be higher overall taxes, right? As we know, with individuals, you have a scaling rate or a sliding scale. So as the income gets higher, you pay more taxes, and that is, it goes up to 45%. So that is quite high. And if we compare it to that, then 27% looks really good. So when I'm saying that there's higher overall tax in many cases, it's not making sense right now, right? But listen to me and listen through this. Because what happens is the company itself pays the company tax. But once those profits are distributed out of the company, then dividend taxes may also come into play. So when you look at the overall tax costs, the effective tax burden can be significantly higher than many people expect. Now, this is why I always say, do not stop your analysis at the first layer of tax. Look at the full extraction path, because if your intention is eventually to enjoy the profits personally, then you need to understand the total tax effect, not just the company's tax rate in isolation. Okay, so I just want to show you what I mean by this with an example. So like I said, in South Africa, we have a company paying a current tax rate of 27%, right? Corporate tax rate on its profits. So what happens is, so if your company makes 100 Rand, then you immediately pay 27 Rand in tax at 27% of the 100 Rand, right? So you're now left with 73 Rand in the company. Now, the part that people forget is when you want to take that money out for personal use, you don't just get to withdraw it tax-free. You are going to be paying dividends tax on it at 20% of that remaining amount. So 20% of 73 Rand is 14 Rand 60, which means what you actually receive in your pocket is 58 Rand 40. So out of 100 Rand of profit, you've paid a total of 41 Rand 60 in tax. Now that's an effective tax rate of 41.6%. That's what you need to think about, because many people compare the 27% tax rate to their personal tax rate and think that the company is cheaper, but that is not always the full picture. Alternatively to drawing a dividend, you can draw salary from the company, but again, you're going to be paying PAYE on it, and that amount could be relative to in your individual name. The tax rates may also work out to a similar cost, right? So that is where you may be paying a higher tax rate. And you need to ask yourself things like, what does it cost me to actually access the money from the company? Because you don't live inside that company. You are separate from the company. You live separately. And that's where the full tax part matters. Because you have profits, then you have company tax, then you have your dividends, then you have your dividends tax, and then you get the cash in your hands. So now, to be clear, that does not always mean that the company is a bad option. In fact, in many cases, it is the better, more preferable option. But it really depends on what you want from the company. So a company can be very effective if you are reinvesting profits, if you are building a portfolio, or not drawing the money out immediately. But if your intention is to use that income personally, then ignoring that second layer of tax can become very expensive. And this is exactly where I see people make costly mistakes. They structure based on the first number that they see instead of understanding the full financial outcome. And when it comes to property and long-term wealth, those differences compound over time. Now, this is just on taxes, right? And remember that taxes are not all of it. Sometimes we cannot avoid tax in every manner or just look at it from one angle relating to tax. There are very other important factors that we do need to consider and why that would make a company very beneficial. So moving on to the downsides, we spoke about the higher overall tax rate and the effective tax rate. The next thing is the capital gains tax, which again is less favorable because companies do not get the same annual exclusion that individuals do, and their capital gains tax treatment is generally less favorable. So that means if you plan to hold property for years and then sell it at a gain, a company can be much less efficient from a capital gains perspective. And again, this is where many people lose money long-term without realizing it up front. We will do a little bit of a case study towards the end to demonstrate what I'm speaking of. Then individuals and special trusts. Now, individuals and special trusts have a 40% inclusion rate, resulting in a maximum effective rate of 18%, right? Companies have an 80% inclusion rate when it comes to capital gains tax, resulting in a 21.6% effective tax rate. Right, so that's what we mean when we say that capital gains tax is more costly within a company. But like I said, I will show it to you within a case study towards the end. The third thing is that financing can become more difficult. So a lot of people just assume that a company structure often makes them look more sophisticated to lenders. But in practice, financing through a company can be more difficult. Banks will require more documents, they charge differently, or they still insist on personal surety anyway. So you may not even get the full practical benefit of liability protection if the bank is still tying you through your personal surety, right? And this is why this needs to be looked at realistically, not just theoretically. Now, the fourth thing is that there's more admin, there's more compliance, and there's more costs. So a company may come with moving parts. For sure, you have company compliance, accounting requirements, tax filings, annual returns, and more ongoing administration, which people forget about or they don't think through, is that when you register a company, you are not just registering a company and then that's the end. You've got to do a lot of submissions. You're paying SARS, you're paying the accountant. You've got to get your taxes filed. You've got to have your documents in order. So there does come a certain level of responsibility with this. Right? So a company provides you structure, but that structure also comes with maintenance. And if you are not at a stage where you truly need that complexity, then it may simply become an unnecessary cost. But again, even with the more admin, the more compliance, a company can work out better for SARS. They trust in the company structure more when it comes to declaring incomes and expenses, and the audits are less intensive. Now I really want to zoom into one point that is extremely important, which is the estate planning. Because this is often where company conversations become more nuanced. So if you own the property personally, then that property itself will form part of your estate when you die. But if you own it through a company, you may instead own shares in the company rather than owning that property directly. And they can offer more flexibility. So, for example, it may allow for better structuring of ownership across family members, and in some cases can create more estate planning flexibility when properly planned. And the important thing to note here is with proper planning, because the company is not just a magic solution on its own. It needs to be part of a broader strategy. So if a person is thinking seriously about family wealth transfer, succession planning, or structuring ownership over time, then the company route may start to become more attractive. And this is why I keep saying the answer is strategic, because the best option depends on the lens that you are using today: the tax on the sale, the personal risk, the bank finance, the estate planning, or the future scalability. So if you would like I'm saying, if you would like there to be continuity after you die without your family members being affected, then a company is better, because what happens is otherwise it falls part of your estate, it dissolves within your estate, and this takes a large time, and so nothing can happen during that time. Right? Whereas the company offers that continuity. So let's make this now practical. A personal name is usually better if you are a first-time property investor, if you want long-term capital growth, if you plan to live in that property, if you want simpler financing, if you know that you do not and will not need partners, and you want to keep the admin simple. So this is where a lot of ordinary investors fall into. And in those cases, personal ownership often gives you a cleaner, more tax-efficient route. But a company is usually better if you are building a property portfolio, if you want partners or investors, if you are doing property development or flipping, if you need stronger liability protection, or if you want more flexibility around structuring and reinvesting profits. And definitely much better for long-term planning, for estate planning, for continuity planning. So in other words, when property becomes a business model, right, not just a personal investment, then the company route may start to make more sense. And this is really the heart of it, because you need to ask yourself, am I buying a property or am I building a property business? Those two are not the same thing. So this is where things get even more interesting, because sometimes the answer is not either or. Sometimes the answer is both, in between, the hybrid strategy. So long-term investment properties may be better held in a personal name, while higher risk, development-based or multi-partner deals may be suited to a company. And this is often where the smarter structuring happens, because this allows you to balance tax efficiency, risk protection, and scalability. So instead of trying to force every property into the same structure, you must now build it intentionally based on the purpose of each asset. So that's a far more strategic way to think about it than just to take all your properties and put it into one box. You need to think of the purpose behind the property and then decide which structure is better fit for it. Let's now go through some common mistakes that people make. Right? I'm going to highlight these because they are very costly. They become costly mistakes. They're not just mistakes. They are common and very costly. Mistake number one would definitely be putting a property in a company just because it sounds more professional. This happens all the time. People assume that company ownership automatically means you are doing things the smart way. But if the numbers and strategy do not support it, then it is just complexity without any benefit. Mistake number two is ignoring the capital gains tax. So this is another huge one, because people just focus on today's transaction and forget about the exit. So if your goal is long-term growth, then the capital gains tax outcome matters a lot more. Mistake number three is not considering estate planning. This is another huge mistake. They're all huge mistakes, actually. Some people buy personally without thinking about the estate consequences, and others buy in a company without understanding how the structure needs to be managed strategically. Either way, ignoring succession and estate planning is very short-sighted. Mistake number four is mixing personal and business use incorrectly. Structure only works when it is respected. So if you are going to use a company, then the separation between you and the company needs to be handled correctly. Mistake number five is not structuring before the purchase. And this is probably one of the most painful mistakes, because once a property is already bought, changing that structure afterwards becomes difficult and becomes so costly. So the right time to think about the structure is before you sign papers, not after. So if I had to simplify this into a practical rule of thumb, it's going to be this. If you would like to buy and hold, then your personal name is often better. If you would like to build and grow, build and scale, then a company will make more sense, right? Often makes more sense. But even this is still a general rule, because the final answer always depends on your income level, your purpose for the property, your financing situation, your risk profile, your family and your estate planning, and whether this is an investment or an actual property business. So please do not make this decision based only on what other people are doing. Make it based on your own numbers and your own strategy. So just a little case study that we have here, right? We have a property value of 1 million rand when it was bought, and it was sold for 1.5 million. So as you can see, the first thing we are comparing is the rental income tax. The blue is for individual. So the rental income tax is higher, meaning what you are paying taxes on yearly is higher in an individual name as opposed to a company name, which is marked in red. But then in the next slide, we have capital gains tax on sale. So once the property is sold, once it was sold for 1.5 million, that is where the individual paid a lot less than the company paid, right? With the rental income tax, there's just a short difference. But with the capital gains tax, there is a large difference. So again, we see the wealth outcome over time in the individual capacity, the blue line, this is your personal after tax, it has grown a lot more. Whereas with the company, it has grown slightly shorter, at least 50,000 shorter than the individual, right? So the difference is in the long-term wealth impact. But again, it is going to depend on your structure. So wrap this up. Let's wrap it up neatly now. Buying property in your personal name can offer better capital gains tax treatment, simpler financing, lower admin, and strong suitability for long-term individual investment. Whereas buying through a company can offer liability protection, better scalability, partner flexibility, a cleaner separation, and stronger alignment when a property is being run like a business. Neither option is automatically correct, and neither option is automatically wrong. So the real question will become, what are you trying to build? Because once you answer that property, then the structure starts to become a lot clearer. And that is exactly why at HM Accounting, we always say that this is not just tax, it is strategy. If you found this video helpful, make sure that you subscribe to this channel for more practical business and financial insights. And if you are currently trying to decide how to structure a property purchase, or you want to understand the tax and financial implications before you buy, reach out to us at HM Accounting, book a consultation with us, and let's take you through it. Because it's always easier to structure correctly at the beginning rather than to fix an expensive mistake at the end. So see you in the next video. I will put the link to book an appointment with us in the description box. Please do like, follow, subscribe, share, all of the things. Until next time, bye.